The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Market breadth improves, and so too does investor sentiment. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. And let's talk about this market right now. The S&P 500 higher by about 0.7%. Big tech participating, but not leading. The Nasdaq 100 up about 0.3%. A really interesting tug of war going on between Alphabet and Nvidia, which we'll get into. But I have to spotlight the Russell 2000 leading in a big way. That is your outperformer when it comes to the indices right now, up about 2% on your small caps. And then take a look at the 10-year yield, Romaine, down about 2 basis points. We have broken back below 4%, but who knows how much further we'll go. Yeah, tug of war going on in the bond market, but go back to equities. The Russell 2000 certainly a bright spot on the day, and so too is the S&P Equal Weight Index, outperforming once again, a barometer for broader market participation and a barometer that has outperformed its cap-weighted brother from another in 3 of the past 4 sessions now. In fact, of the top 10 movers in the S&P today, only one, Keysight, falls into the tech category, and not a single one of those stocks has a market cap above $50 billion or a weighting above 0.5%. And some folks say that's actually a good thing.
My conviction is continuing to be long in the market, and I think that what we keep going back to is the fact that there's skepticism. There's really this idea that we're seeing a skeptic investor, so we think it is an opportunity to add. And then finally, we like the breadth. I mean, that's the real thing that I think is, even during this year, has been clouded.
Of course, this doesn't mean tech is down for the count. The rotation in the broader market, well, it's also been a rotation within the tech sector itself. AMD, Nvidia, Oracle pushed to the side in favor of Applied Materials, Cisco, and how about Alphabet? The increase in divergence, evidence that the recent stumble in the AI trade less the beginning of the end, and maybe more a changing of the guard. Now, while there still are a lot of question marks around the AI trade, there are probably way more questions right now around consumer spending. You had improved guidance from companies like Kohl's, Best Buy, and Dick's Sporting. That offers some hope for a miracle holiday season. However, you also had disappointments out of the Home Depots, your Targets, Bath and Body Works. Remember them? Candles, Katie Greifeld. And you can't really ignore that. Nor can you ignore the government retail sales data that we just got showing consumer spending losing some steam in September, Katie, as we headed into that government shutdown.
When we talk about the dispersion that we're seeing among some of the retail names, let's talk about the dispersion that we're seeing when it comes to the AI trade. I think this chart behind me is pretty shocking. You have Google, Amazon, and Meta normalized in terms of their percent change over the last year. Take a look at that side of the chart. That's where things get really interesting, because you have Alphabet in white there. And you can see that Alphabet only really started to break away at the start of September. They had been trading places before them. It was actually Meta that was in the lead. But you think about the stars aligning for Google. You had the endorsement from Berkshire Hathaway, Gemini 3 launching in a big way, and also a lot of progress when it comes to their chips as well. You can see that reflected in the shares, Romaine, and it really goes again to this idea that you can't just talk about the AI trade as one big block. There's a lot of nuances here that have emerged just in the past couple of weeks, the past couple months.
All right, Katie, you know I love a good alligator chart there. So let's kick things off with Mimi Duff, head of the New York office and senior client advisor over at Gentrust. And Mimi, that chart actually says a lot. I mean, we talk about a picture being 1,000 words, but it gets to this idea of that a lot of investors have been searching for something other than Nvidia. At least for right now, I think some tech investors think they found it in Alphabet. And then we look at the outperformance today of the Russell and the S&P Equal Weight Index. Also seems to suggest investors have found a home somewhere other than Nvidia, Microsoft, et cetera.
Yeah, I think it's important to have broad holdings, as it's difficult to tell who the next leader will be. Easy to look back, but looking forward, you want to own a broader set. Right now, we're in a situation where the top 10 names in the S&P make up 40%. So in order to make that play away, we like the equal weight as a part of our portfolios.
When we start to talk about the potential staying power of this outperformance, we've certainly seen this with the Russell, where the Russell will outperform for a few days or maybe in a couple of weeks, and then it basically gives all that back over the next few weeks or months. And I am curious if this ends up being a head fake again, because I've always looked at the Russell, even the mid caps to a certain extent, as being much more tied to the economic cycle. Right. And there does seem to be some concern about where we are in that cycle.
Well, certainly they're more, I would say, more sensitive to interest rate risk for certain. But when we look at the S&P 500 earnings, we did see broad beats across, 80% of the companies beating. So we're hoping that we'll get a bit more staying power on this broader trend.
Well, I always wonder, when we talk about perhaps equal weight, perhaps small caps, mid caps outperforming here, is it a catch up to the rest of the market, to tech, for example, or is this tech going to potentially catch down?
It's a great question. I think time will tell. Right now, the earnings beats have been, the last quarter, they really were concentrated in the tech and communication services. So we need to see some of that the other folks outperform more.
Absolutely. Well, let's talk about the other.
That was a great question, Katie.
Thank you. Thank you. I have several of them.
I know.
Let's talk about the other big debate going on in markets right now, outside of what's happening with AI, and that's what's happening with the Fed. What's going to happen in December, whether or not we're going to actually see that rate cut come through. How much does that matter relative to the conversation about 2026 and that outlook?
Well, I would have thought it didn't matter that much, but the markets are telling you it matters. For me, the conversation or the question was, are they going to take a pause in December or not? Right now, I think we have more than 80% priced in for a December cut. And really, just before I came here, I was looking at the composition of the voters. The voters on the 2025 and 2026 Fed are on the dovish side. So I think the bigger picture is, will the Fed continue along an easing path? Right now, we've got about 100 basis points of cuts now through the end of 26, and not a lot of data. So we need to see that catch up in data for the next year's information. But right now, looks like December's in play.
In play, although, I mean, most of the Fed members will try to tell you that it's not in play, or at least that they might pause. But it gets to this idea, too, heading into next year, whether December's in play or not. The idea the market is expecting multiple rate cuts over the next 12 months. And it also gets to this idea of where the dollar goes next. If we're starting to get rate cuts, you layer in some of the fiscal policies that haven't really sort of come out, meaning some of the provisions in the big, beautiful bill that really start to kick in next year, and a few other policies. It raises a lot of questions as to whether we should be betting on a weaker dollar into 2026.
Yeah, right now we've seen quite a big move. Now I think we've seen a decent amount of consolidation, dollar-euro somewhere around 115 right now. And I think that we just need to wait to see how things play out there.
Well, let's talk a little bit more about fixed income when it comes to duration, the fact that you're overweight duration, because the thing that I keep hearing from investors is that you want to stay up in quality and you want to stay shorter on the curve. So let's specifically talk about the duration piece and what you're seeing there when it comes maybe towards the longer end or even the middle of the curve.
So this might not be as exciting, but we went longer duration in the municipal bond market.
Okay.
Oh, talk to me. Talk to me.
Someone's excited about that.
They got really, really cheap after Liberation Day, and we took advantage of lengthening there. On the taxable side, we don't really have a long duration play right now, although we did add inflation protection in the taxables.
All right. Well, I mean, look, we've talked a lot on this. What was it, a couple of weeks ago? We had a guest on talking about what cash is for the cool kids, and I guess munis are, for the winners right now, if anything. But we've heard this before, too, and it kind of upends this whole idea of what's safe in this market and what's risky. I mean, obviously, the risky stuff is easy to point out. But it seems like the safety trade, if you will, has kind of gotten overlapped with, I guess, things that weren't safe, or no?
I don't know. I mean, this year, I think bonds are often overlooked. I don't want to call them misunderstood, but this year we've put in a really strong year for bonds as well as stocks. And I don't think anybody was coming into this year cheerleading like, oh, it's going to be a good year. So here we are.
I think one of the reasons why bonds are perhaps misunderstood is that it's not clear that they're behaving as that typical hedge that the textbooks would tell you that they should. Certainly the yields are relatively high compared to recent history, but where do you fall in terms of them acting as that portfolio ballast?
Yeah, this very interesting thing that you point out, because the recent couple weeks when we saw a lot of the speculative trades wobbling, some of the tech names, the crypto, just, you name the speculative, the bonds didn't really react in that flight to quality fashion. What I will say is I think if you were to see recessionary fears and a much more aggressive Fed, I absolutely think that bonds would react there. So they have a place in portfolios.
All right, Mehdi, always a great conversation. Mehdi Duff, head of Gentrust New York office and senior client advisor there, kicking us off to the close here on this Tuesday afternoon. Katie Greifeld, it is a Tuesday. When we come back, we're going to have a sit down with Michelle Meyer over at Mastercard to talk about the recent trends in consumer spending, the recent trends in retail, and what to expect for the Black Friday and beyond.
And then Gary Vaynerchuk takes us from the checkout lines to alternative lines of investment and what he's seeing in terms of appetite for new and unique places for investors to park cash.
And we're going to talk a lot about what's going on in the C-suite, a lot of changes, and a lot of folks now saying, what does it even take to be a CEO in this environment? We're going to talk to Mark Thompson and Byron Loflin over at Nasdaq about their new book and their advice for anyone looking for that C-suite job. That's coming up next here on The Close. This is Bloomberg.
White House National Economic Council Director Kevin Hassett is emerging as the front runner for the next Fed chair, according to sources close to the process. Now, a Trump ally who favors low interest rates, Hassett could bring a sea change to the central bank, whose policies he has criticized in the past for being behind the curve. Joining us now to discuss is Bloomberg's Enda Curran. So, Enda, talk to us a little bit about the horse race here. What did Kevin Hassett do or say that put him in pole position?
Well, from the outside looking in, Mr. Hassett is seen as being closely aligned with President Trump's view on the economy, if not politically. We know, for example, he's called for lower interest rates. We know that he's being critical of the Federal Reserve as an institution, needs to change up the way it does things. He's talked about, for example, how they look at data and what kind of data they should be using. And he's also been, by the way, pushing bigger picture ideas as well, such as that we might right now be in the kind of an AI-driven productivity boom, which of course ultimately means good growth and low inflation, which means lower borrowing costs. So he's been clearly marking himself out to be sharing a similar view to President Trump when it comes to the economy. But all of that said, though, this process, is continuing. We know that Treasury Secretary Bessent has got 5 on his shortlist for the final round of interviews. And then those final names will go to President Trump at some point over the weeks ahead. And there's expected to be a final decision by Christmas. The White House today made it clear that nobody knows what decision President Trump will finally make. We all have to stay tuned. But right here, right now, our colleagues are reporting that Mr. Hassett is certainly leading the pack.
Well, that's what I'm curious about, Enda, is how much insight we have into the actual decision-making process. I think back to the selection of Jay Powell, and we now know in hindsight just how instrumental the then Treasury Secretary was at the time, Steve Mnuchin, in helping sort of shepherd that through. Is this a situation where Bessent will basically say, this is the person I want, and Trump will sign off on it? Or are we kind of waiting for Trump to basically parade everybody out in his typical TV fashion and then make a decision on his own as to who he wants?
Well, there's clearly a political angle this time around that's much more explicit than previous Fed chair picks remain, to your point. And because of that, a lot will come down to which candidate President Trump probably thinks he can trust the most. And of course, from the outside looking in, the suspicion, if not concern, among investors and economists will be whether or not the president can lean on that next Fed chair and, of course, threaten the Fed's independence. So these are the kind of factors that are in the mix this time around. It's not just clearly being based on who's got the most economic chops behind them that can take on a job like this, leading such an important agency. We also know, again, on the political side, that President Trump is very unhappy ultimately with Chairman Powell as Fed chair. Of course, he was encouraged to pick him by his previous Treasury Secretary, Mr. Mnuchin. So the thinking this time around is it's going to be very much President Trump's pick in terms of who gets that job. And that's why there's an air of volatility to this. But among the 5 candidates, it seems to be at least starting to narrow down. And President Trump himself has said recently he's already made up his mind on who he wants to pick.
And as such, let's build on that. What would a Kevin Hassett Federal Reserve look like beyond just lowering interest rates?
Well, on the one hand, of course, he would need to command the respect of investors and economists and, of course, real participants in the real economy. If he's seen as coming in and just being a political extension of the White House, that would probably soon start to rebound on the Fed because it's meant to be seen as an independent agency operating with its own impartial view on the economy and what the economy needs. That's not, of course, saying the Fed should not be accountable and does not make mistakes, but that's the prism in which it's seen. Whereas I think if he's seen as coming in as political, he might struggle to win over investor confidence. And that's some of the points that some economists we're making today. But nonetheless, whoever takes over the Fed will, of course, have an opportunity to shape it and mould it in their own kind of outlook for what it needs for many years to come in terms of its staffing, its resources, its budget, how it thinks about data, how it looks at data. So there's plenty of levers a new Fed chair can pull.
All right, Enda, got to leave it there. Enda Curran of Bloomberg helps to lead our coverage here at Bloomberg. Of course, right now, the parlor game, trying to figure out exactly who President Trump will pick to be the next chair of the U.S. Federal Reserve. When we come back, we're going to talk about the retail space, seeing a big spike in shares of Kohl's. In fact, having its best day on record. Dick's also getting a bid here. Is this a read-through into broader retail trends or something specific to those two names? Find out when we come back. This is coming up next here on The Close. This is Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with Eat, Brinker International. Citi raising to a buy rating for the parent company of Chili's and Maggiano's. The analyst saying that younger guests have flocked to the brand, building confidence in longer term relevancy. The shares having a pretty great day, up about 9%. Best day going back to April 9th. Up next, Oracle, a downgrade over at CFRA, down to hold. The price target being cut to 230 from 350. The analyst seeing a number of risks ahead, including mounting debt concerns and heavy reliance on OpenAI. Those shares down about 2.5% on the day. And finally, Estee Lauder, Rothschild Redburn cutting the cosmetics company to sell. The price target going down to 70 from 83. The analyst flagging the need for deeper investment in order for the company to close the gap with its beauty peers. Those shares down about 1% on the day, and those are some of our top calls. We do want to stay in the consumer space and do a quick check-in on Kohl's and Dick's Sporting Goods. Both shares doing well on the day on the back of their latest earnings results. David Swartz joins us right now, senior equity analyst over at Morningstar Research, to talk a little bit about here some of the broader trends. And David, I want to start with Kohl's first, because I know that the beat that we saw in this most recent quarter, and I know that a lot of the ills that have plagued Kohl's have been more idiosyncratic and specific to Kohl's. I am curious as to how happy you were about the numbers that you saw, and more importantly, how happy you think you're going to be with now the announcement about the permanent CEO going forward.
I wouldn't say I was happy about the numbers. If you're a retailer, you don't want to be reporting negative comps, and Kohl's is still reporting negative same-store sales, as it has been now for more than 3 years. So this is still a company that is struggling, but the numbers this morning were better than expected. The company reported a negative 2.8% same-store sales decline, which was a couple points better than what people thought. And also the margins were okay. They held up pretty well. And that gave some people some confidence that the company was on the right track. And the guidance for the full year implies a little bit better fourth quarter than what people had thought. Now, of course, it's very early because we haven't even reached Thanksgiving yet. So nobody knows exactly how the holiday sales period will come about. But, you know, I do think that Kohl's is headed in the right direction after really years of just one catastrophe after another, including earlier this year when the former CEO, Ashley Buchanan, was fired in a scandal. They announced an interim CEO, Michael Bender, who had been the chairman. And as you mentioned, yesterday he was named the permanent CEO. So that does give the company some stability, and that's something that Kohl's desperately needs.
Yeah, absolutely. And just to see the reaction in shares up 40% intraday, pretty stunning. Let's talk a little bit about Dick's Sporting Goods as well, because they also offered improved guidance on Tuesday. The share's not rallying as much. And I'm curious where you stand when it comes to Dick's, because, okay, you take a look at the shares, they're a little bit underwater year to date, but I'm taking a look at your notes and you still view them as somewhat overvalued here.
Yeah, I do think that Dick's is a bit overvalued. The company has a lot going on right now because it just closed the acquisition of Foot Locker back in September. This morning's report was quite complicated. The company threw a lot of numbers at us. But if you look at the underlying Dick's business, it was quite strong with a 5.7% same-store sales increase. Now, Foot Locker, though, was quite weak in the time that Dick's owned it, which was about 2/3 of the quarter. Foot Locker actually lost money, and its comparable sales for the quarter were down almost 5%. So Dick's is taking over a business that is really kind of troubled right now, and will need a lot of work. and is going to depress Dick's margins at least for a couple years and probably longer than that, because Foot Locker has considerably lower margins than Dick's does, and that's not going to change in the near term. Dick's has said that it's going to be blowing out a lot of inventory at Foot Locker over the next few quarters, and that's going to require significant markdowns, and that will impact margins. So it's right now it's kind of a difficult period for Dick's, but the company has been performing very, very well, and in fact, I may raise my $170 fair value estimate on it after the numbers that were reported this morning.
Well, I am curious. That's interesting. And I am curious, David, too, just looking ahead, we're going to get some earnings tonight out of Urban Outfitters. And that stock has actually done pretty well this year, actually setting up for what could be its best year, I think, going back to at least 2016 or 2017. Are you encouraged at all about some of the progress that you've seen out of Urban, particularly headed into the print tonight?
Yeah, definitely. Urban Outfitters has been doing really well. This is a retailer that for many years was sort of treading water, but in the last couple of years, Anthropologie and Free People have really performed well. And Newly, which is a rental business and online selling business that that Urban created a few years ago, has really been performing well and growing extremely rapidly. And people are starting to notice Newly as part of the Urban Outfitters portfolio. And then the namesake brand, Urban Outfitters itself, has been struggling for the last few years, but it actually seemed to turn a corner in the last quarter. And it has new management that seems to be getting it back on the right track. So most of the parts of Urban Outfitters appear to be performing better, and that's reflected in the stock price.
All right, David, great to preview some of that and talk through the action with you. That is David Swartz. He is senior equity analyst over at Morningstar Research. Meanwhile, we do want to bring you some breaking news. This out of the gaming and prediction market space. A judge ruling that Kalshi is subject to Nevada gaming regulation. You can see the reaction in some of their competitors there. DraftKings, for example, Penn and Flutter, all rising on this news. We're going to try to bring you more detail here, but I will point out that Nevada has sent a cease and desist order to Kalshi as recently as March, the state's regulators there, so interesting to see this come through. But coming up, fresh consumer confidence and retail sales data out today. We're going to break that down with Michelle Meyer. She is chief economist over at the Mastercard Economics Institute. That conversation up next. This is The Close.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping a close eye on these markets, also keeping a close eye on the consumer, of course, through the lens of earnings, but also we're finally getting some economic data as well.
Yeah, delayed economic data. Obviously, this is from September, but it did show consumers kind of pulling back a little bit, and that's concerning because everyone assumes this was also before the government shutdown, so everyone assumes that once we got to the government shutdown, we might have even seen a further pullback. But it kind of doesn't necessarily overlap with some of the earnings we've gotten, which seem to be relatively positive.
Yeah, that's the thing. It's interesting to see, two different stories emerge when it comes to corporate America and, of course, what the official data is showing. So let's keep.
I bought something yesterday. What'd
you buy?
Yeah, I was on my sick bed. I can't like it's a gift. It's a gift, so I can't tell.
Fine. I assume this was on your laptop.
It's not for you, but
okay. Well,
don't worry.
You still have at least a month to go. Actually, a month exactly until.
It's a gift card for a tattoo.
Beautiful. Okay, let's go back to the consumer and bring in Michelle Meyer. She is chief economist over at the Mastercard Economics Institute. And Michelle, talk to us about this sort of rift you're seeing form between what we're getting when it comes to the official data, also data from the Conference Board coming out today. It's certainly weak when it comes to U.S. consumer confidence. Then you take a look at some of the earnings that we've got just in the past few days. You have Kohl's, Best Buy, Abercrombie & Fitch, and Dick's Sporting Goods, just some of the names offering improved guidance in terms of what they see. I wonder what you make of it all.
So we can add to your list of information the data that we're monitoring and looking at very closely, which is our spending pulse figures, where we did similarly see a little bit of a softer September. By the second half of October and into November, we saw a really nice acceleration in spending. So for the month of October, retail sales ex autos are up about 3.5% on a year-over-year basis. And we think that's a really good indication for where things will go as we look into the holidays. Back in September, we released our holiday sales forecast, which was for 3.6% year-over-year growth during that holiday season. With the e-commerce story really resonating, almost 8% year-over-year growth in e-commerce. So the data that we're seeing now with October coming in that mid 3% pace, this acceleration to early November, I think very much speaks to a consumer that is still engaged and ready to shop during this holiday season.
Which is interesting because, I mean, you just listen to some of the anecdotal data, if you'll call it that, about, people are feeling stretched right now. They're feeling frustrated. But it kind of reminds me of the pandemic when the narrative was very much, okay, the consumer is miserable, but they're still spending. And I wonder if you see any parallels between that period of time and what we're seeing now.
There are, in the sense that there was just a lot of uncertainty then, and there's a lot of uncertainty now. I think the consumer feels a bit unsettled because it's hard to predict what comes next when you have so many different headlines hitting that could influence your personal welfare, right? Your finances. So even think about the government shutdown. There's a lot of uncertainty. Will the government reopen? What does it mean for me personally? How do I think about the path forward for the economy? And that could be unsettling, which could have been contributing to some of the conference board surveys that we saw, the consumer sentiment surveys we saw for November. But I think a lot of it ultimately comes down to what can I afford as a consumer who's coming in and shopping? Do I feel like I have the ability to find the best value? Do I feel like I have the way to make my purchasing power work the most that I can? And do I feel like I have enough income today and future income in order to facilitate that spending? And the labor market, although it has certainly seen a lower rate of churn, it is still largely supportive. And there's still a lot of values out there. There's still a lot of promotions hitting, and consumers still have a lot of choice.
So is that a good thing, though, Michelle, with regards to the promotions? I mean, we were talking on the show last week about how most of us, our inboxes, email inboxes have already been flooded for the last couple of weeks with Black Friday deals, and I put that in quotation marks because apparently Black Friday was about 3 weeks ago, not 3 days from now. And it gets to this idea. I understand from a consumer's perspective that's good and entices us to spend, but how is that going to shake out when we start to see earnings in 3 months from time? Are we going to see margin compression? Are we going to see some pain for some of those retailers that maybe discounted too much?
Well, I mean, I'm sure retailers are trying to be as savvy as they can in order to make sure they're maintaining their market share, they're enticing the consumer, but they're doing it in a way that doesn't sacrifice their profitability. And, they're also navigating a different cost environment than they were last year. Last year, we had deflation, certainly disinflation for many categories. Costs were lower, and they were able to do even steeper and more meaningful discounts. This year, it's a little bit more targeted. Because we do have some of the tariff-induced price increases, some changes in terms of labor market conditions as well. So retailers are trying to navigate all of that while still maintaining that consumer interest.
So, Michelle, when we add all this up and we talk about kind of the state of the economy through the lens of obviously consumer spending, I guess my question for you really isn't so much whether things are stable now, but the idea is, do you think that this is going to carry over deeper into 2026, or is this sort of the last hurrah for consumer spending, or is this just kind of that reset and we'll get back to whatever the baseline normal used to be?
It's fascinating. I feel like there's been that story of a last hurrah for consumer spending throughout this whole cycle, because there's been this question of how long can the consumer continue to engage? How long can the consumer power this economic cycle? And I think there's just like a lot of swings in consumer spending, right? We've gone from periods where consumers have paused, they've waited, they've tried to assess what's going to come next in terms of the economy because of a heightened uncertainty or fear of the health of the labor market or their own, again, personal finances. And then they come back in when they feel a little bit more settled or they feel like it's the right moment to spend. So there's always some volatility in terms of consumer spending, just like there's volatility in the overall economic cycle. But to me, as long as the labor market continues to move along, as long as there's a low firing environment, wage growth continues, consumer balance sheets are largely healthy, and I think consumers will remain pretty engaged in this cycle.
Well, that's what I was wondering, Michelle, because again, we're starting to get some economic data delayed, but at least it's coming out. And I wonder if what we're seeing when it comes to this still resilient, still spending consumer, whether that tells us something about the labor market, or is that not necessarily the direction that this information flows in?
No, that's a fascinating question, because we've been trying to figure that out ourselves. The fact that we see consumers spending into October and November at a healthy clip, does that indicate that indeed the labor market may have recovered a bit more? The September data showed a pickup in non-farm payrolls, so the numbers certainly improved in terms of job creation, although the unemployment rate was a little bit weaker with that pickup. So we'll see how things play out. We know from the jobless claims numbers that firing rates remain pretty low. We have other labor market indicators from ADB and from other private sources, but it's really hard to figure out the full picture, I think, until we get that BLS data.
And Michelle, just so we understand the relationship. So if we were to see a cooling down in the labor market, perhaps a contraction, I mean, how meaningful would it have to be to really impact consumer spending in a meaningful way? What do past episodes tell us?
Well, it's circular, right? When the cycle starts to shift, it kind of shifts together and feeds on itself. So the extent to which the labor market weakens, you start to see job reduction because of a stress on corporate America. That means that purchasing power of consumers won't be as strong, and consumers will start to cut back, which then fuels back into companies resizing their workforce. So it's kind of a natural feedback loop in the economy. And that's certainly not happening at the moment. We're in much more stability, and seems like from what we're seeing from actual spending that stability continues.
All right, Michelle, always a pleasure. Michelle Meyer, Chief Economist at the Mastercard Economic Institute. A closer look at the retail space heading, of course, into the Black Friday, the unofficial start of the holiday shopping season. When we come back, we turn back to tech, we turn back to the broader market, and we turn to our stock of the hour. It's a twofer today, a closer look at NVIDIA and a closer look at Alphabet, and, well, a bit of a freaky Friday as these two sort of swap places. That's coming up next here on The Close. This is Bloomberg. Time now for our stock of the hour. We give you a twofer today in the AI space. Alphabet and NVIDIA swapping places here as a lot of investors now looking to some of the recent deals that Alphabet has made with Meta that maybe suggests that there's another player in the AI chip space. Let's bring in Mandeep Singh, our global head of technology research over at Bloomberg Intelligence, to talk a little bit more about this. And without getting too in the weeds here, we know what NVIDIA has to offer, but apparently Google, Alphabet, has these, quote, TPUs to offer. And I guess Meta and a few other companies are saying they may not necessarily as good as the Blackwell chips, but good enough.
Yeah, look, to me, Gemini 3 feels very similar to that DeepSeek moment earlier in the year, simply because the focus once again has shifted to CapEx efficiency. What can you do with $100 billion in CapEx? And, in the case of DeepSeek, they weren't even spending this much money, and they were able to train a frontier model that was comparable in performance. What Google has shown with Gemini 3 is using their own chips and their own stack, they've been able to catch up to OpenAI and Anthropic in terms of all the different types of use cases for generative AI. So that's where everyone is asking that efficiency question again. And who does it hurt the most? I think NVIDIA, and which is why you're seeing that kind of a reaction.
Well, talk to us, too, about the OpenAI of it all as well, because, of course, when we're talking about chips, yes, NVIDIA seems to be the loser here. But you think about the other big news coming out of Alphabet this week or this past week was the release of Gemini 3. And when it comes to a head-to-head matchup between ChatGPT and Gemini 3, it's not clear that OpenAI is the winner in that conversation.
Well, so what all these frontier LLM companies are doing is, and Anthropic actually released their new model yesterday after Gemini 3. So they said they continue to lead in coding agents as a use case, and they are really specializing and doubling down on that. ChatGPT, to me, probably has their hands in too many things right now in terms of the use cases, but clearly they still have a lead when it comes to, chatbots and those type of use cases. Gemini has carved out its own niche with image generation. So all these models continue to get better in certain tasks. I don't think you have a world model that is good at everything, although these companies aspire to get there. So that's where it's going to be very iterative, and CapEx efficiency is the one metric that investors who are funding this do care about. You don't want to spend, $500 billion and realizing your model is not the best, which could be the case with Meta. And I think that's the reason why they are considering the use of Google TPUs.
I am curious, Mandeep, are there any other players out there that kind of stealthily have some chips maybe on the shelf or something that maybe some type of technology that could be updated in a way that could also potentially be a challenge, or is Alphabet it?
I mean, look, all these Chinese companies that don't have access to the latest NVIDIA GPUs, they are still training their models. They're still adding new functionality, and they've been able to do that without using the latest NVIDIA chips. So I think that's where necessity is the mother of invention, and that's where you've seen that with TPUs.
Yeah.
I think people will try to experiment with AMD chips as well, and I think all these companies will try to diversify their exposure to NVIDIA.
All right, Mandeep, it'll certainly be fun to follow. That is Mandeep Singh. He is Global Head of Technology Research for Bloomberg Intelligence. Meanwhile, coming up, we'll take you to the closing bell with Scott Chronert. He is U.S. equity strategist over at Citigroup. This is The Close on Bloomberg.
When we look at the S&P 500 earnings, we did see broad beats across, 80% of the companies beating. So we're hoping that we'll get a bit more staying power on this broader trend.
Mimi Duff over at Gentrust kicked us off to the close 50 minutes ago. We should point out, since then, stocks have picked up a little bit of steam into the close, but we should point out, Katie, volume is incredibly light, as you would expect here on this holiday shortened week.
Yeah, here Thanksgiving is coming up on Thursday. Maybe people peeling off early, but even though the trading volume is low, breadth is pretty broad right now. More than 400 names in the S&P 500 in the green, just 70 in the red. And it's all the names you need powering the index higher. Meta, Broadcom, Microsoft, Amazon, Apple, Alphabet. On the downside, you do have NVIDIA. And that gets back to what we were talking about when it comes to dispersion in this AI trade.
Yeah, absolutely. Here, a broad-based rally here on the day with two of the big leaders that had led us all year long sitting this one out, more than 400 names in the S&P 500 in the green. As we move closer to the closing bells, let's bring Scott Chronert into the conversation, U.S. equity strategist over at Citigroup. And Scott, there's been a lot of talk about kind of what, I don't know if we say what ails the market, but the idea that over the last few weeks, we've certainly seen a bit of a rotation out of some of those high-flying tech names into other names as well. And it gets to this idea, is this a sell-off that we had seen earlier this month, or was this just simply a repositioning amongst a lot of investors after sort of, I guess, locking in to a certain degree some big profits on a lot of those big tech names?
Well, I think our view was that going into that Q3 reporting period, our biggest issue was the hurdle in terms of implied growth expectations was awfully high. And what you saw as you went through the reporting period was this upside surprise dynamic, but with limited follow through. And then, last week when you got the NVIDIA results and once again, very strong, everything seemed to be working very well, but a negative, fallout in terms of the stock price action. I think it just kind of resonates with investors that, hey, here we are at the index level up low teens year to date. We've navigated a whole host of volatility items and discussion points over the year, from DeepSeek to the April sell-off with Liberation Day, and then the budget negotiations in the summer. And now here we are again, beginning to discuss about the persistence of the AI infrastructure spending. And what this kind of led us to was a view that, hey, you're looking at an investor base that in many ways, shapes, and form is just outright exhausted, given the way this year's gone. So the fact that you have an up index, I think, but still limited response to good news is suggestive that, hey, we're in a pretty decent place to where let's lock gains in, let's get to the end of the year, and then re-engage as we start next year.
What sectors right now, Scott, as we get towards the end of the year and really into 2026, give you the most confidence in terms of performance?
Well, we're not backing off on our longstanding tech overweight here. We did balance it with the comm services downgrade going into Q4, but I still think we can't ignore this growth driver. But what I would say is, this is kind of interesting. We were looking for a more cyclical broadening into Q4, and that was going to be in areas such as financials, potentially the consumer area on a rates play. But interestingly, you look at what's happened quarter to date, and you got healthcare jumping off the page at you. Healthcare is market weight in our books, but we acknowledge that there was a really attractive valuation set up there. We just felt that there was still a lot of policy noise to be navigated. But what you're seeing is as that policy noise dissipates, that sector kind of jumps in and catches a lot of this rotational money.
It's interesting, healthcare, because, we've heard various cases for why healthcare should outperform. And as you say, right now it's jumping off the page. But I feel like it's a sector where it's hard to really attract the tourists in. Unless you really know healthcare and know the specific names, it's easy to get caught off sides in a specific name that has a specific catalyst. And I wonder if that theory holds any water with you.
Yeah, I think it does. I mean, when you're market weighted sectors where you've been, it just says, hey, look, you can still stock pick here. And there are still good underlying growth stories. But heck, navigating whether it's tariff discussions, drug pricing, go down the list. It has made this stock selection game a little bit more difficult. So, the sector level, ETFs, if you will, become a really natural way to play this. And so I think they've been a flow and volume attractor as this quarter's unfolded in particular.
And Scott, specific to healthcare, I wonder how the M&A discussion folds in, because that's been named as a potential catalyst at different times, that this is a sector where certainly you could see some deals emerge. We've even seen some bidding wars in the past couple of weeks. Do you view that specifically as a catalyst?
Well, I think, Katie, it's a really good question. So yes, we have seen some M&A. You look at an area like biotech, which is very pervasive as you go down cap into small mid cap. It doesn't take much in terms of deal flow down there to generate some enthusiasm for the underlying sector call. And so again, when you look at how all of this plays out, yeah, it's a target-rich environment from a merger and acquisition perspective, and probably even a divestiture perspective. But as you take it down cap and you give investors some reason to come back to that left behind SMID area, it kind of plays to this as well. So several different approaches, but I think you're spot on. I think the M&A backdrop here certainly is among the things that's, again, triggering some of this rotational money.
I am curious, Scott, just about your general take on the consumer spending side of this economy, particularly heading into the holiday season, and whether some of the names in the stock market that are most exposed to that will actually see some benefit.
Well, I think we've been discussing for quite some time now this bifurcated consumer, those that are net savers versus those that are net spenders. And we felt that the net savers is where most of the wealth effective equities has lived. It's also been the beneficiary of higher Fed funds rates because they own most of the money market assets. So our view is that that part of the consumer is actually in pretty good shape, courtesy of stronger stock markets. Now, we certainly have to navigate this labor situation. But if you really step back and look at the price action going through this quarter, the market peaked on October 29th, which was that last Fed rate decision. And recall what happened. You began to take some of the urgency off of that December rate cut, and stocks have had a really tough time since then. Now, you move all the way through to what we're looking at this week. Even with today's discussion around who the potential next Fed chair might be, you've begun to see the odds of that next Fed rate cut in December pick back up. No surprise, the market's acting better. What I'm getting at with this is that the market has been telling you that, particularly in areas like the consumer, it needs lower rates. And the way the market's been navigating the rate cycle out of the Fed is that, hey, a little bit more confidence that perhaps that's coming. Not a surprise that you're seeing a pretty strong reaction today among the retailers specifically.
Absolutely. Scott, got to leave it there. Scott Chronert, have a wonderful Thanksgiving. U.S. equity strategist over at Citigroup. Stocks not far off of their session highs. Katie Greifeld, we should point out, we get several earnings after the bell tonight, including from HP Inc., Urban Outfitters, NetApp, Autodesk, Workday, and a few others.
Yeah, and of course, we'll be breaking them down right here on the close.
I think so, Katie Greifeld.
That's
we
the
do
plan.
do that. That is the plan. Were you here yesterday?
I was.
I wasn't.
It was okay.
You have to tell me how it went. Our simulcast starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar, Tim Stenovic, they're in the radio booth, as always, locked in their cage. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube, Carol Massar. You seem very excited here on a day where the market's getting...
Because you're back.
A pretty nice bid. Thank you.
Were you sick?
No, I was locked in the dressing room. I couldn't get out for 24 hours.
Got to work on that, Romaine. You're a pretty smart dude.
Just text me if
I had to wait till Matt Miller came in this morning to
Oh
let me
my
out.
gosh.
It was very terrifying.
He let you out?
Yeah.
I'm surprised. Hey, what an interesting day. I don't know that I want to go as far as saying risk trade is on, but I mean, most names in the S&P are higher today. It's just kind of fascinating to see this as we get ready for the Thanksgiving holiday, because I expect tomorrow's going to be quiet.
Yeah, the Russell 2000, though, is really where the action is today, just off its best levels of the day, but still up, Katie, more than 2%.
Yeah, absolutely. The small caps seeing a lot of love today. It's interesting, the pair trade that's going on in big tech right now, which seems to be buy Alphabet and sell NVIDIA shares. So as such, you add it together, and the Nasdaq 100, the underperformer, which, you know, we don't see too often.
Yeah, and I mean, we should point out, too, I mean, even before today, Alphabet had really been outperforming NVIDIA. I think on a year-to-date basis, it's returning about double what NVIDIA is returning, which says a lot. I mean, we're talking about 70% gain in Alphabet shares this year, which for a company that size is nothing short of phenomenal.
I know you listen to my gainers, and I've had like Alphabet on my gainers list a bunch of times over the last week.
I'm sorry, you're what?
Yeah.
Exactly. He wasn't listening.
Yeah, sorry.
Nice, nice.
All right, we do get the closing bells. We should point out volume is significantly lighter than what we have seen over the past couple of weeks. This is, of course, normal for a holiday shortened week, particularly with the Thanksgiving holiday. Usually the day after Thanksgiving, it ends up being one of the lowest volume days of the year. And today is basically a preview of that. The Dow Jones Industrial Average, nevertheless, adding more than 600 points or 1.4%. The S&P 500 up more than 60 points or 0.9%. The Nasdaq Composite is going to finish higher by about 0.7%. But it's really the small and mid caps, the cyclical names, if you will, that outperformed in a big way, including the Russell 2000, Carol, up 2% on the day.
Yeah, pretty significant, that outperformance there. Hey, let's go back, though, to the big caps, if I may. S&P 500, Katie, 426 names actually gaining ground on this Tuesday, 74 to the downside and 3 unchanged.
And you also saw pretty good breadth when it comes to the sectors, though not a perfect score. 8 in the green, 3 in the red. I think it is so interesting that you had tech actually finish a little bit lower on the day because you had Alphabet hitting another all-time high, but still, you think about some of the names on the other side, NVIDIA included, and it netted out to a little bit of a negative downdraft. Healthcare, though, consumer discretionary communication services, some of your biggest winners on this day.
All right, we are getting some earnings out of the software space right now. Autodesk out with their results for the most recent quarter, third quarter EPS. Looks like a beat, $2.67 a share. The street was looking for $2.50 net revenue in the quarter, beating modestly by $1.85 billion. The street was looking for $1.81. Here's your guidance going forward for the current quarter, the fiscal fourth quarter. The company says that revenue will be in a range of 1.9 to 1.92. The lower end of that range is well above street estimates of 1.86 in EPS. $2.59 to $2.67 a share. Once again, the lower end of that range, Katie, above the average of street estimates. So beat and raise quarter here for Autodesk.
Well, let's talk a little bit about Workday, too, because you take a look at the after-hours share price moving higher by about 7%. That's after they boosted their full-year subscription revenue forecast. They see their fourth quarter subscription revenue coming in at $2.36 billion. That is above the estimate of $2.35 billion. So that's the look ahead for the third quarter revenue coming in at $2.43 billion. That's slightly above the estimate. Similar story when you take a look at third quarter adjusted EPS coming in at $2.32 above estimates of $2.17. So again, you can see the reaction in shares is positive at the moment, Tim.
All right, shares of the data infrastructure company NetApp were surging higher. Now they're higher again, 4% in the after hours. The company boosted its fiscal year adjusted earnings per share forecast. The company sees third quarter net revenue at $1.62 to $1.77 billion. Estimate was for $1.71 billion. Second quarter net revenue came in above estimates. The company still sees fiscal year net revenue $6.63 billion to $6.88 billion. Shares in the after hours up about 4.8%.
All right, guys, I'm going to go back to some individual gainers as we await some more earnings. earnings. I'm just going to bring up Google and or Alphabet and Meta Platform on one screen. We, of course, know the news that we were talking about Google versus NVIDIA all day today, but the news was that Meta is said to be in talks to spend billions on Google's AI chips, adding to a months-long rally that we've seen in Alphabet shares that has made the case that it can rival maybe NVIDIA as a leader in AI technology. So this story has been out there. Shares of Alphabet finishing the day about 1.5% higher. Meta Platforms finished the day with a gain of about 3.8%. So just wanted to show those together. Real quickly, two retailers, outperformers, Abercrombie and Fitch, finishing the day with a gain of about 37%, excuse me. The company raised the low end of its 2026 net sales and earnings per share guidance range as its Hollister brand continued to gain momentum. And you did lift kind of some other names in the space. American Eagle and Urban Outfitters also were higher. Keep in mind, the stock is still down 40% year to date with 12% of the float short. And Kohl's
and we should point out, we're expecting to get Urban Outfitters after the bell tonight, too.
Thank you for that. Yeah, good point. Kohl's also up about 42% in today's, soaring to its highest in more than a year. It raised its full-year outlook for the second quarter, adding to kind of a steady stream of retailers reporting stronger than expected results. So some major outperformance in that one as well. Right.
Okay, some underperformance in the name of some chip stocks, namely NVIDIA, down 2.6%. It was down as much as 7.1% earlier in the session. AMD also fell today, 4.2%. That was down as much as 9.7% in the session. Carol just talked about why Alphabet's Google has been doing so well. This information report that Meta Platforms is in talks to spend billions on Google AI chips known as tensor processing units or TPUs, sending shares of NVIDIA and AMD lower. Looking at JM Smucker Company today, too, shares slid 3.7%. They hit their lowest intraday level at one point since early July. The company lowered the top end of its full-year guidance ranges. The company also canceled a planned price increase on coffee due to tariff relief. Cafe Bustelo, Dunkin', and Folgers are in its coffee brands. Romain, I know you are watching what's going on with Dell right now. Yeah, Dell Computer. I'm actually going to reverse this here and start with the forecast for the full fiscal year. Dell is saying that adjusted EPS will be at its midpoint of $9.92 a share. It had previously seen about $9.55. So it looks like it's basically nudging up its adjusted EPS outlook by just a smidge here, also nudging up its revenue guidance for the full fiscal year to $111.2 billion to $112.2 billion. Wow. The previous range that it had given was 105 to 109. So a raise here on the forecast. As far as the quarter that just was, it does look a beat on that as well here. Looking at roughly about 11% gain here on operating income for the most recent quarter. The company also saying that revenue in the quarter also up 11% to $27 billion. So we should point out that that does look like a slight miss of street estimates. The street was looking for about 27.19 here. So it looks like the numbers for the most recent quarter relatively in line to just a smidge below what the street was looking for, but a guide higher for the rest of the year. All right. So from high tech to consumer discretionary we go. As we mentioned, retail earnings. Urban Outfitters, man, folks, it was up 9% in the regular session. It is soaring in the aftermarket, up about 16%. Let's go to the third quarter. Third quarter comp retail segment sales up 8%. The estimate was for an increase of about 5%. Third quarter EPS of $1.28 a share. Again, we're just looking for some more color here from the company. That third quarter net sales is a beat. Keep in mind that this stock has been up about 24% year to date, but about 15% of the float is short. So we'll look for some commentary a little bit more when it comes to what they're seeing for the consumer.
Yeah, interesting to see shares up about 15% after hours, though. A different story when it comes to Zscaler. Shares moving about 5, 6, 7% lower right now, moving quite a lot. This is after actually their second quarter revenue forecast came in higher than estimates. They see revenue between $797 million to $799 million. The estimate had been for $796.1 million. So still not really tiding over investors here. First quarter results came in adjusted EPS 96 cents versus 77 cents year over year. The estimate had been for 86 cents. So a beat there as well. Also a beat when it comes to revenue versus expectations, but still tough crowd. You can see Zscaler shares down about 5% right now.
Okay, you're watching Zscaler. I'm watching ticker WOOF in the after hours. That's Petco. It's up 7.75% in the after hours. The company did report fourth quarter net sales down low single digits year over year. Fourth quarter adjusted EBITDA forecast, though, did beat estimates. Third quarter net sales coming in at $1.5 billion. The estimate was for $1.47 billion. The company sees fourth quarter adjusted EBITDA 93 to 95 million. The estimate was 92.4 million. This company has been getting beat up, not just this year, going into this earnings report. It was down more than 22%, but going back to all-time highs, down close to 90% from those all-time highs. That was back in January of 2021.
All right, quick check on Dell that just reported. It's still up about 1.5%, bouncing around a little bit, but up about 1.5% in the aftermarket. Urban Outfitters up almost 13%. Zscaler down about 5.5%, folks. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals, we call it the closing bell. Katie and Romaine continuing there on the close on Bloomberg TV. Tim and I continuing on Bloomberg Business Week Daily on radio. We will see you again, same time, same place tomorrow.
When we come back, a closer look at the tech sector. We got earnings out of Autodesk, Workday, and Dell. Still awaiting results out of HP Inc. Stick with us, a deeper dive into the health of the AI trade and into the tech sector when we come back here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A low volume day on Wall Street, but never mind. It was enough to put green on the screen pretty much across the board for all of the major indices. The S&P 500 up for a third straight day, 0.9%. But more importantly, take a look at the S&P 500 equal-weighted index here, which of course strips out the cap weighting, gives you a better idea of broad market sentiment. That underperformed for the third time in the past 4 sessions. Also saw huge outperformance in the healthcare space. The S&P 500 Pharma Index up 3% on the day, and that is a record high for the index as a whole. Meanwhile, Bitcoin once again sitting this one out. Katie Greifeld down about 2%.
Yeah, just can't catch a reliable bid here when it comes to crypto. But let's take a look at some of the day's biggest movers on the equity side. Have to talk about Kohl's, of course, reporting earnings. They named their permanent CEO. Still a miss when it comes to comp sales, but shares up over 42%, just stunning there. And then talking about some of the biggest name in techs and the pair trade that emerged today, Alphabet. Of course, a lot of positive noises being made about their TPUs. That is to the detriment of NVIDIA, down about 2.6%. I will note that Alphabet finished off its highs. NVIDIA finished off its lows, and that brings us to our top story this hour, and that is tech's turnaround. The Nasdaq 100 finishing the day in the green, pairing a 1.3% drop. Alphabet, as I mentioned, helping to lift the index higher, with Meta reportedly in talk to spend billions of dollars to use Google's AI-focused chips. Now, investors, as a result, left questioning NVIDIA's dominance, with the chipmaker falling more than 3%. Now, this as traders digest more earnings results out of tech names, including Dell, which just hit in the past few minutes, Romaine.
Absolutely, Katie, and we talk about this idea of the beat that we saw in those numbers, but more importantly, a lot of people really focus in on those AI server orders. We did see that number get bumped up. Remember, they were sitting on about $12 billion of a backlog, that backlog up to $18 billion, and the company now saying that it's raising shipment projections for the year to $25 billion from 20. Mehdi Hosseini joins us right now, senior equity research analyst covering technology hardware over at Susquehanna. And Mehdi, it gets to this idea here when we talk about the last earnings report that we got out of Dell, and more importantly, that investor day that they had a few weeks ago. There were a lot of question marks, not just about their bullishness, but when we would see actual numbers applied to that. What you learned today out of this earnings release, did that give you any additional confidence?
No. I think the 25 billion of AI server booking was expected. We still don't know how they're going to hit the 50% EPS CAGR. The problem I have with Dell is they're well positioned for AI storage and also notebook, but it's the margin and the cost. Cost is going up, especially higher cost of DRAM, SSDs, and other components. For every dollar of increase in cost, Dell could pass 60 cents to customer, but there's a 40% of the cost increase that they have to absorb. On top of that, AI servers are 5% gross margin. That doesn't get me excited. So until we know how the margins are going to be able to stabilize and how Dell will be able to have some operating leverage, I remain neutral.
Well, on that margin point, I mean, they did have somewhat decent margins, 12 for that unit that specifically includes the servers, more than 12%, and that was above street estimates. What does that say to you?
I think we actually published on this a week and a half ago. I think there was a end of the year a budget flush among enterprise customers. I think that uptick in margin has to do with a better enterprise server, which in my opinion is a one-time event, is not sustainable, and therefore gross margin pressure will resume.
I also do want to talk a little bit about the consumer PC business as well, because of course there's a lot of focus on what they're doing with AI there. But when you take a look at that point of the business, what does it tell you, taking a look just at these numbers that have crossed in the past few minutes?
Well, 75% of Dell's PC business is commercial. We have already gone through some corporate upgrade due to the expiration of Windows 11. What I want to see looking into next year is what will be the catalyst for enterprises to upgrade a notebook deployed by professionals. I don't see a crystal clear, and AI is not really a factor when it comes to notebook. So we need better visibility in order to expect the growth acceleration in the notebook business.
And of course, we do have the earnings call starting at about 4:30, it looks like. What would you like to hear from the C-suite on this call?
I'm going to repeat what I wrote after the Analyst Day, which took place in October. Give us details. Give us the building blocks, how earnings would grow 15% CAGR over the next couple of years. Without details, there's always going to be a skepticism around margins, and we need to better understand the details behind the strategy.
I am curious, Mehdi, when we start to talk about longer term and this AI infrastructure build out, particularly when it comes to more of the server side rather than the PC side here, and this isn't really specific to Dell, but overall, is the pace that we've seen in this, is that going to be sustainable at least through next year, or should we start to think about a ratcheting down of that growth rate?
I actually expect Dell to see growth acceleration because pretty soon we're going to migrate from AI training to AI inferencing. Enterprises deploy AI servers in the edge, and Dell, given their brand name and their channel, could definitely be a beneficiary. What I don't know is how they're going to be able to scale services. They have been lowering their OPEX, and this is how they have been able to try to offset lower gross margin. But when you cut OPEX, you also limit yourself how you can scale services. So the extent that Michael Dell and the team could help us understand how services could be scaled given the current OPEX could be a huge factor in changing our mindset. And again, Dell could be a significant beneficiary as AI is deployed among enterprises, but we need to know how.
All right, Mehdi, got to leave it there. Appreciate your analysis there. That is Mehdi Hosseini. He is Senior Equity Research Analyst over at Susquehanna International Group. Meanwhile, we do have earnings coming out of HP Inc. And here's the headlines. They see 2026 adjusted EPS between $2.90 to $3.20. The estimate had been for $3.32, so quite a miss there when it comes to the look ahead. Here's the other part of that. They're also planning 4,000 to 6,000 in job cuts by the end of fiscal 2028. So their profit outlook, they fell short of estimates and also announcing job cuts as a result, Romain.
Yeah, and this gets maybe to the idea that Mehdi was talking about here, too, the idea that these companies are selling a lot, but the margins on what they're selling specifically are relatively narrow, and so they have to start thinking about some of those cost cutting.
Absolutely. We'll continue to follow that story. And coming up, consumer confidence taking a hit ahead of the holiday season. We'll discuss next. This is The Close on Bloomberg. New data out from the Conference Board today showing that consumer confidence fell the most since April in the latest period, reflecting anxiety about the labor market and about the economy. Here to discuss is Yelena Shulyatyeva, senior U.S. economist at the Conference Board. Apologies, I'm going to practice.
That.
I know.
Practice.
I get nervous on camera. But let's talk about these figures, because certainly to see consumer confidence drop by the amount that it did definitely turned heads here. And I wonder how much of this we can chalk up to the fact that there was a government shutdown versus, maybe something a little bit beyond that?
It was broad-based, okay? So it was jobs, incomes, and financial situations. So that's one thing. Another thing is that consumer confidence usually falls during the shutdown. So if you look at the past instances, you see a decline of 10 index points. So that's not surprising that confidence dropped that much. But what concerns me is, like, if you look at the details, you look deeper behind the hood. So under the hood, it's kind of like financial situation concerns that have fallen most. So, families look at what is happening, right? They look at what is happening on their checking accounts, what is happening with their paychecks, and they're concerned about it. So that, to me, should be influenced much less by the government shutdown than, other things.
Right. So it certainly doesn't explain everything that these numbers said. But I am curious, and this is something we were talking about earlier, that you think about how people are feeling, their confidence. How much does that actually inform what they're spending? Because you take a look at the results out of some of these retailers, it's clear that people are still spending money, still reaching into their pocketbooks.
Absolutely. There's been a significant divergence between how they feel and what they do. And I think the truth lies somewhere in between. So, there is a concern about the labor market, and consumers feel it. It's much harder to find a job. That's what we see consistently over this year in the consumer confidence results. So, it should have some information in it. But at the same time, consumers are spending, and, some consumers are better off than others. So that is also supporting consumer spending. But I think going into the holiday season, that could be a little bit of a concern.
Well, it's a concern for me. And I know Wall Street, they're paid to be optimistic. But we got that delayed retail sales report that seems to suggest a slowdown in spending on services. And we actually saw that in some earnings, particularly out of some of the restaurant chains. And then you have the Conference Board's data for November, which is more recent, that also seems to suggest a pullback in services. So when we start to see more official data on what really transpired post-September into this holiday season, are we going to be alarmed?
So that's a good point on services. I totally, if you look at the details of the consumer confidence report, you see a pullback in expectations on how consumers are going to spend, how much are they going to spend on discretionary services, such as restaurants and amusement parks and whatnot.
Yeah.
So that is a
amusement parks kind of scare me. I like
well, that's my favorite, but anyway, I think it is a concern. And September is usually on a seasonal basis. It's not a big month, right? So you're just done with a back to school shopping, and you are going into the holiday season later. So yeah, September results are weak, but let's see what happens in October and November. I think will be a little bit of a weakness, but not like a collapse. So I think it's still going to be an increase in terms of holiday sales, but probably a softer one than before.
I wonder how the Fed factors into all of this, because you can debate the impact of a single 25 basis point rate cut, but does it have any impact that you can see in terms of how consumers feel, the lived experience in this country?
I think it's about the labor market more than anything else right now. And the risks to the labor market remain elevated. And you see it in the consumer confidence data. You see it in a little bit of an increase in the unemployment rate. So these kinds of things will push the Fed's hand in December, I think.
All right, Yelena, always a great conversation. Always wonderful to talk to you. Yelena Shulyatyeva, senior U.S. economist over at the Conference Board. A closer look at the economic data out of the Conference Board, out of the government, and of course, as we move deeper into the holiday season, what the retailers are going to have to report. And Katie, we talked about this a little bit earlier, this idea that a lot of these retailers really did start their Black Friday promotions a little bit earlier than what we would traditionally see. And I don't know if that's a sign that maybe they're panicking, or maybe we should just be grateful as consumers that we're getting 25% off whatever knick-knack we don't really need to buy.
Well, you have to wonder if the deals are even that good. I mean,
know.
That's the thing. I have a pretty high bar for me to actually feel good about making a purchase.
So what, you don't get out of bed for under 50, for more, less than 50%?
Yeah, I like to, there's some great thrift stores over in New Jersey, Romaine, just across the river. So that's where I spend a lot of time.
Two places I try to avoid.
Okay, New Jersey and thrift stores. All right. Anyway.
All right, when we come back here, we got the one and only Gary Vee. He's going to be joining us in just a second to talk about his latest investments catching his attention, including, I don't know if you saw this, Katie Greifeld.
Tell me.
That Superman comic book.
I did see that.
It's all the talk of the town.
It's no Batman.
It's coming up next here on The Close. This is Bloomberg. All right, well, last week, the only thing Katie Greifeld talked about was that rare first edition Superman comic that sold for a record $9.12 million. It highlights the voracious demand for alternative places to park your cash. And it capped off a big week of auctions with paintings by Gustav Klimt, as well as Frida Kahlo, also raking in record-breaking amounts. Our next guest believes collectibles may become the next big pillar of lifestyle spending. Joining us here in studio right now is Gary Vaynerchuk, the chairman and CEO of Vaynerx and VaynerMedia. Great to see you here, man.
Great to see you. Happy holidays.
Happy holidays. Let's start off with the Superman. I wasn't actually as surprised by this, but it gets to this idea. I mean, it wasn't just the Superman comic, but we've had other sort of collectibles. And I want to take out the Klimts and the Frida Kahlos, because we know there's always been demand for that type of art. But to see Superman, or to see, a gold chain from the hip hop era get auctioned off at Sotheby's, you're starting to see things, particularly from my generation, that people are valuing in a way that I think if you thought about it maybe 20 years ago, you said, there's no way we're going to see the type of valuations ascribed to those things.
Every meaningful collectible that has been outside of paintings that are sold at Sotheby's, antiques sold 30 years ago at Sotheby's or Christie's, vases, clocks, watches from late 1800s in Europe, at the time weren't a collectible, right? Trading cards in the 50s in this country, people that are watching right now, dads had them in their bike spokes or threw them against the wall. New collectibles have always emerged. Humans have always collected. And by the way, contemporary art, go read Boom, go read the history. In the 60s and 70s, people were making fun of the art that was made in New York.
Yeah.
And that wasn't European art, and now it's selling for 10, Jackson Pollock, Andy Warhol, Basquiat. So, to me, you're right.
Yeah.
Our generation, I just turned 50 the other day.
Yeah.
Comic books, trading cards, sneakers.
Yeah.
We're seeing a new game, but the numbers, look at these numbers on the screen. The numbers are real, and I think a lot of people think this is an anomaly or a one-off. I think this is the preview, and I think collecting is now joining fashion, music, sports in the lifestyle genre game. Everyone's collecting something is kind of what I see from 5 to 10 years from now.
I am curious about how you value something, and I know that valuing art has always been more art than science, pun intended. But when you start talking about sneakers or these other sort of more contemporary items, is there sort of a way that we value this, or we're just kind of just playing it as we hear it?
Well, we're playing it like the way everything's always worked. What are two people willing to pay for it?
Yeah.
and who's got the big wallet and who's got the little wallet in that situation. I think this is about demand. I think this is about expression. We live in a social media world where people want to show people what they have. Fashion has always been that. We wear the clothes we want, and why am I wearing this hat? Like, it's all that.
Yeah.
I just think that the returns are hard for the audience that watches this show to deny over the last half century, let alone last decade.
Right.
The returns are the returns.
Yeah.
Like, at some point, people are gonna be like, this is not silly anymore.
Yeah.
People are genuinely interested in these things. Because for me, for example, I'd rather own a trading card or a comic book and have that go up in value than the same equivalent of a stock. 100 shares of Tesla is not as interesting for me going up as one rare rookie card or a collectible. It has extra value.
Right. Well, it has sort of value that I would assume some sentimentality.
Nostalgia.
The argument might be it doesn't necessarily have the liquidity that people might value if they own 100 of Tesla shares.
I think that's fair.
Yeah.
I think that's fair. And I'm sure everybody who's got a half a brain that goes on this show talks about diversifying. I think that's fair.
We've heard that one before.
Yeah, you've heard that one? I think that's fair. But to take even a step further to a lot of the stocks I like here, the CPG landscape, I think collectibles, if you look back in the 50s, 60s, and 70s on Madison Avenue, a lot of these CPGs, the Pepsis, the Hostesses, they integrated collectibles. You look at Hershey's, what they just did with Pokemon. I think collectibles are not only something people are going to collect for monetary value, but I actually think a lot of Fortune 500 companies are going to start using collectibles to drive their day-to-day business.
Well, Gary, what I'm curious about when we're talking about collectibles, are we talking about actually owning the object itself? Because there's a lot of platforms and different firms out there that try to basically securitize these things and offer shares.
Well, now you're getting into like probably the most exciting thing. When you start layering these collectibles into fractionalization, you start talking about what the blockchain can actually do instead of just speculation. Yeah, I think what Wall Street did for companies and fractionalized, I think you will see for collectibles. So that $9 million, one of the reasons so many people that are thoughtful are buying the best of the best is they realize, wait a minute, I'm going to sell the ownership of this $9 million comic book in fractional shares, and it's going to be worth 17 million because a lot of people like me are going to maybe not put up 9, but I might put up 100,000 for me. Somebody might put up $1. So yeah, I think fractionalization, the blockchain, the things you're seeing ahead of us. We're looking at the Mickey Mantle right now. Those numbers are going crazy, and I think you're starting to see new things go. Video games are starting to emerge as collectibles. In like a Fortnite sold for $40,000 the other day. That's a new game. Forget about Pac-Man and Donkey Kong. So again,
and computers, and smartphones,
correct. The first
original,
iPhone. I'm telling you, I think the audience that watches this show is underestimating this overarching collectible insurgence that we're going to see in people diversifying. But again, going to be activated by Fortune 500 companies to sell their day-to-day products. The best way to sell a bunch of cereal right now is to put a collectible in it like it's 1965. And I think the Kellogg's and the Hostesses and the Pepsis and the Coca-Colas are about to wake up to this trend. The data's pretty clear for anyone who's paying attention. And it is a little more fun. In general, people are looking for a little joy. There's a lot going on in the world. And this is a fun place for people. And it creates community. You look at Comic-Con in San Diego and Javits Center. There's a reason the comic book, the nerds, that whole Revenge of the Nerds thing, it's here.
It's here.
It's here.
It's happening now. Gary, unfortunately, we have to leave it there.
Devastating.
Hope to have you back soon.
Willing to host the whole show if you guys need.
It's
Gary,
better you than
anytime.
Thank you.
And by the way, I'm just crying thinking about all the comic books I threw out
over
the years.
Well, don't
baseball
cry.
cards.
Don't cry.
Records.
We just have to hold it together until 5 p.m.
I could have been somebody, Katie Reifeld. I could have been a contender.
Gary Vaynerchuk, great to speak with you. That is Vaynerx chairman and VaynerMedia CEO Gary Vaynerchuk. Meanwhile, let's take a look at some of the names moving in the after hours. It's still earnings season somewhere. Dell, you take a look at the reaction right now, cooling a bit, still positive. Petco actually popping quite a bit. Needed some good news, this stock up about 9%. Urban Outfitters also rallying in a big way, up about 12%. Different story for Zscaler, down nearly 8% after hours. This is The Close on Bloomberg.
The job market may be strained, but not so much if you're in the C-suite. CEO turnover is accelerating this year, with recruitment surprisingly active at the highest levels of corporate America. That's according to data out of the Conference Board and Russell Reynolds Associates. But our next guests, they're out with a new book that says no matter how well positioned the candidate, the odds are usually stacked against CEO hopefuls. Joining us now are world-renowned leadership coach Mark Thompson and Byron Loflin, who is NASDAQ's global head of board advisory, and they are the co-authors of CEO Ready, What You Need to Know to Earn the Job and Keep the Job. Seems like the last part of that is the most important one. But let's start about what's getting the job, first of all. I mean, what exactly are companies looking for out of a CEO candidate today, and how does that differ from maybe what they were looking for in the past?
Well, you know, it's been amazing to see how if you're an inside candidate and you're lucky to be on that elite shortlist, they're looking for someone who can actually be an evangelist for change and bring in that new character for the company if they need to transform, and everybody's being challenged to do that. Whereas if you're an outsider, you now need to do the opposite. You need to show that you can hit the ground running and that you have context and that you won't kill the culture that you're trying to harvest and evangelize. So.
But one thing we've seen a lot lately, and Byron, and it gets to this idea of kind of like when these CEOs come in, whether they're internal or not, change, as you know, is not always well received by the people underneath them. And we've seen a couple of big CEO changes over the last year, including at Starbucks and a few other places, where we've seen them try to implement some meaningful changes and we've seen meaningful pushback by the employees under them. How do you thread that needle?
I think it's important that the CEO comes in and establishes a strong foundation of trust. That foundation of trust, they've got to get out and meet the employees. You look at folks like Hubert Joly when he took over at Best Buy. He established that level of trust that was critical for all those from the top down through the organization started to believe in the vision of that leadership. And I think that's an essential thing to build first.
They were in a kind of an existential place at the time, too. So when Corey Berry had to come and fill her shoes, she sent a letter that said, 6 pages filled with things I need to get better at. So it's that humility, too, that's necessary, I think, to really appreciate what's there and develop the team.
I want to talk a little bit about the board and how they come into these conversations, because there's this idea out there that one of the biggest jobs that the board of a company has is to look at CEO succession and make sure that that is a smooth process. You think about the conversations that the Disney board must be having right now, for example. I mean, is that still the case in this current environment? Would you say that is one of the top jobs that the board needs to actually nail?
Absolutely. Succession is the ultimate act of stewardship. And it ensures that leadership compounds like capital over time. That is an essential role of the board, and to think about it in those terms about compounding leadership, which goes back to compounding trust.
And I want to talk a little bit about the rise of the co-CEO model more, because it's something you're seeing more. I think about, the asset management industry where I spend a lot of time. Dimensional, for example, has co-CEOs, and it's a model that sometimes works, but sometimes it doesn't. And I just wonder why we're seeing more and more of these situations arise.
It's still very rare, but I think it has to do with what Byron was just talking about in terms of complexity and the disruption going on right now. And it's the board's hedge. It's a bet on 2 superstars to say, if you can pair a great technologist with a founder or a great execution machine with a great technology machine, now you think about how extraordinary and impossible it is to be a CEO today. Sometimes having those two characters in place is critical. The key, though, is the thing that makes or breaks it, and the reason it doesn't work out is because of swim lanes. They have to be so explicit. The board has to have that plan, and you have to decide who makes what decision and when and what those goals are.
Well, that's what I'm curious about. Why do you even need the co-CEO? I mean, because that structure you talked about, certainly we've seen in the tech startup space, that's been the model. You have the grand visionary who maybe started it, but that person maybe moves up to the chair and then, or to some other role, and then you actually have more of a manager, if you will, in the CEO slots. But it seems like a lot of companies are resistant to doing that for some reason. Yeah, or maybe the founders are resistant to it.
Well, there you go. And you were mentioning earlier how you might have the boomerang CEO. So sometimes being able to pair that founder who's charismatic and visionary with someone who is really maybe known for getting things done in a new way. So they're able to attract both this sense of legacy, but also energize it and make some changes that are necessary.
The other thing I'm curious about, Byron, too, is also about compensation and how that gets structured, because that's changed a lot as well. And obviously you have some extremes like whatever the heck's going on over at Tesla. But even when you get beyond that level, we've seen some very intriguing pay packages, including pay packages that seem to be negotiated specifically by the CEO, him or herself.
It's always interesting to me to come across CEOs who the pay package isn't as important as their vision. And I've known CEOs who reject the pay package because it's too high. Which it's that idea that humility is not timidity.
How often does that actually happen?
Very rarely.
But
I'd like to see it happen more, frankly. I mean, does money really bring happiness?
Well,
there's a point at which you've got to have it, and it brings no question that enough does.
Right.
But too much.
Right.
I was with a gentleman and happened to run into a former CEO, and he's coaching a lot of depressed CEOs because they're wondering what to do with their lives, particularly after they make a big sale.
But that gets to the idea of the board selection process. So, assuming the C is not already there, the idea of what are they hiring? Are they just hiring someone to be a manager? Are they hiring more of the visionary, someone who will get more fulfillment out of building whatever they're trying to build?
In the work I do, it attracts, I think, the ones that have a vision. They're about change. They're about building the esprit de corps in leadership that changes the composition, meaning changes the attraction of talent to their organization.
Yeah.
I mean, that's one of the key indicators of a strong leader. Do people want to work for them?
Yeah.
I talked to a company recently. People were coming back out of retirement because they said, I want to work for that guy.
Interesting.
Yeah.
Well, I do want to ask you guys specifically about your book, because again, the title here, CEO Ready, What You Need to Know to Earn the Job. Is the intended audience just CEO hopefuls, or does it speak to a broader part of the population as well?
Good question. Thank you. Absolutely not. This is written for, first and foremost, I would say for board members to understand that succession, the responsibility of succession in a holistic way. That they're seeing the different types of CEOs so they can help evaluate the type their company needs. Because unfortunately, no company is a one-size-fits-all kind of leadership environment. They need to build within their company. And so, no, the book was written for entrepreneurs, board members, people who report to the C-suite, and people who report to the CEO, because it's building the talent pipeline that takes us long-term into the future, particularly in this fast-moving age that we call AI.
All right, guys, really enjoyed this conversation. Have a great Thanksgiving when you get there. That is leadership coach Mark Thompson and Nasdaq Global Head of Board Advisory Byron Loflin, co-authors of CEO Ready, What You Need to Know to Earn the Job and Keep the Job. That's important.
Happy Thanksgiving.
Thanks. Still ahead, a conversation with the CEO of Omaha Steaks, joining us to discuss food inflation and his outlook on the beef industry ahead of Thanksgiving, just 2 days' time. This is The Close on Bloomberg. All right, we're just 2 days out from Thanksgiving, but forget the turkey because Americans can't get enough of beef. The U.S. is the world's largest consumer of red meat, but inflation, tariff pressures, and shrinking cattle herds have sent prices soaring. Despite this, though, our next guest says that American demand for beef remains strong. I'm pleased to welcome Nate Rempe. He is the CEO of Omaha Steaks. Nate, great to have you with us. And we just had that chart up of beef prices. Talk us through what you're seeing in your seat when it comes to the cost of your steaks.
Yeah, I mean, the demand is really high and the supply is low. So my business focuses a lot on the power that we built over 100 years. To leverage flash freezing, where we can buy in the commodities market when we see little breaks in the market, build that inventory, and then leverage, some of our supply chain, leverage our processes and automations to hold our prices pretty static. In fact, America is going to be, I think, pleasantly surprised when they come to omahasteaks.com. They're going to find that our premier gift package, that perfect gift, is going to be $89.99 again this year. And I told my teams internally, this is one of the great moments for Omaha Steaks to really step forward and shine and leverage and flex our muscle that is that vertical integration and that ability to play that commodities market. But, watching the beef market now has been just fascinating from my seat, seeing what it's doing, particularly in grocery stores across the country.
Well, talking about the beef market more broadly, outside of just your business, I mean, when it comes to matching supply and demand, how does the U.S. necessarily boost supply? Or is it just inevitable that you're going to have to try to source beef from overseas?
Yeah, I think there's a lot to be learned about the supply chain of beef in America. Only about 13 to 14% of the total beef consumed in America is imported. And of that percentage, about 80% is lean trim that goes into ground beef. So in particular, portioned steaks and roasts and that largely come from the domestic supply. And, those percentages really give you a sense for how important building the domestic herd is to meeting the demand of America's desire for red meat. And so, imports are an important part of the overall picture, but it's not the solve. It's not the silver bullet to addressing the cost of beef in America. Rebuilding that herd is the inevitable requirement for bringing supply up. And that is not a fast process, Katie. That's a 6 to 8 year process to kind of get back to what would be considered a surplus in the size of the herd.
I am curious, though, Nate, how we do that. And by how, I mean, is there a real push to do that beyond just yourself, meaning a more coordinated push?
Yeah, it's a decision that ranchers and feedlot owners make. It's called heifer retention. It's an industry term that describes holding back the female animal to build the herd as opposed to sending it to market. Now, as you might imagine, when demand is high, there's a lot of motivation for ranchers and feedlot operators to send those female animals to market and take advantage of the optimal live price. But that comes at a cost. And over the last number of years, because of the demand for beef, those female animals have gone to market and have not calved. And the end result is the lowest herd size in 70 years. And so to change that is to make that decision to hold that animal back to build the herd. And we're seeing, early signs of that. But what's super interesting, guys, is that when you make that heifer retention decision, it actually further exacerbates the size of the herd because fewer animals are going to market. So to say it's going to get worse before it gets better.
Yeah. Just real quickly, Nate, we only have about 30 seconds here, but I am curious just about long-term trends, sort of looking really further out and consumption trends and consumption patterns. And I know we've seen oscillations where, we all favor chicken for a while, then it's beef, then it's pork, back and forth. How do you sort of manage those swings?
Yeah, I mean, America trades down really in any product set. And as it relates to beef and chicken, we're seeing some consumers opt for chicken, but it's just not as satiable as a protein. It really just doesn't deliver like beef does. And so we are seeing some trade down kind of inside the product set of beef. Those consumers that may have opted for the filet mignon are now exploring how amazing the top sirloin is, or, a strip or a ribeye, and exploring, up and down the category there and really pushing themselves to educate on where else they can get their beef.
All right, Nate,
like Omaha Steaks.
All right, Nate, got to leave it there. Nate Rempe, of course, the CEO of Omaha Steaks there. As we move closer to the end of the show, Katie Greifeld, we set you up for what to watch over the next 24 hours. It includes more earnings, including in the morning.
Yeah, absolutely. We get earnings from Deere. We also get some data in the form of jobless claims as well as durable goods. Then we have something to look forward to at 2 p.m. as well.
We're going to get the Fed Beige Book at about 2 p.m. here. That anecdotal evidence has become a lot more important for this market in the absence of official government data. Stick around. Balance of Power is up next at the top of the hour, right here on Bloomberg.